Ever find yourself wanting the real story behind a company's numbers, but without wading through pages of jargon? Well, you're in the right place. Welcome to the deep dive.
Yeah, today we're digging into Mangalore Refinery and Petrochemicals Limited, MRPL, specifically their latest results for Q1 of the fiscal year 2025-26. That's the quarter ending June 30th, 2025.
Yes, exactly. We've got their official unaudited results, the standalone and consolidated ones, plus their press release,
And our job really is to pull out the key stuff, the need-to-know insights from all that data.
giving you a clear picture of MRPL's health and, what it might mean for the wider energy scene.
And, well, this quarter, it's definitely got some interesting points, some real operational highs, actually.
But sitting right next to some, let's say, quite surprising financial numbers. So let's unpack that. Okay, let's jump right in. The headline figures for MRPL standalone Q1 FY26.
Right.
So revenue from operations, about 20,988 crore. Let's just call it roughly 21,000 crore.
Okay, which is what, about 2.5 billion US dollars for context?
Yeah, roughly. But then you look at the profit, or lack thereof, profit before tax, a loss, 402.90 crore in the red,
Wow, okay.
leading to a net loss for the period of almost 272 crore.
So a definite loss-making quarter.
Definitely. And the earnings per share, basic EPS, comes out negative, minus euro 1.55 per share.
And the contrast here is pretty stark when you look back. That 21,000 crore revenue figure,
It's down, right?
it is significantly down. Last quarter, Q4 of FY25, they pulled in nearly 27,600 crore.
Okay.
And same time last year, Q1 FY25, it was nearly 27,300 crore. So yeah, a big drop-off in revenue.
And the profit swing is even more dramatic.
Oh, absolutely. Last quarter, Q4, they had a profit before tax of over 584 crore. Positive.
Yeah.
And Q1 last year, a profit of just over 100 crore. Also positive.
So to go from those kinds of profits to a loss of over 400 crore before tax, that's quite the turnaround.
It's a massive shift in just one quarter. Net profit obviously followed suit from healthy positive numbers to this, well, significant loss. And EPS went from positive 2.07 last quarter and 0.37 last year to this minus 1.55.
That really is a staggering reversal. When you see a swing like that, profit to loss, so quickly, what's your initial take? Is it one big thing or several factors hitting at once?
Well, it's nearly always a mix, but
Yeah.
looking at their core business refining, one factor really jumps out. It's the gross refining margin, the GRM.
Okay. The difference between what they pay for crude and what they sell the refined products for.
Precisely. Think of it as their basic profit margin on each barrel they process. And for this quarter, Q1 FY26, their GRM was just US 3.88 cents per barrel.
$3.88. How does that compare?
Well, compared to the same quarter last year, Q1 FY25, it was US $4.70 per barrel. So that's a noticeable drop.
Yeah.
And when that margin gets squeezed, I mean, it directly hits the bottom line. Doesn't matter how much oil you process if you're not making much on each barrel. It makes profitability really, really tough.
So even if they were running the refinery efficiently, which we'll touch on, a lower GRM can just wipe out those gains. Does that mean sort of external market conditions are just more powerful than internal efficiency for a refiner?
In many ways, yes. That's exactly what this illustrates. You could have great operations, run things smoothly, but if the global market for refined products tanks or your crude costs spike unexpectedly relative to product prices, your margins disappear. It shows a key vulnerability for companies like MRPL.
Okay. But despite that difficult financial picture, you mentioned some operational positives.
Yes, that's the other side of the coin this quarter. Operationally, there were some strong points.
Like what?
Well, overall, crude throughput for the quarter was 3.52 million metric tons, or MMT. Now, that is down from 4.35 MMT in Q1 last year.
Okay, so less processed overall.
Yes, but buried in the details, their press release highlights something interesting. They achieved the highest ever crude processed in any April month.
Oh, really?
Yeah, specifically 12,000 metric tons, or TMT, in April 2025. That beat their old record from April 2022.
So a record month within a lower overall quarter. Interesting.
It is, and they also mentioned completing the shutdown of major units in their Phase 2 complex. That suggests they're actively working on maintenance, streamlining, keeping the plant efficient.
Right. Planning for the longer term, perhaps. Okay, so operational bright spots, but overshadowed by that GRM squeeze.
That seems to be the story, yes.
Let's dig a bit deeper then into the costs and the financial health side of things. This is where it often gets quite telling.
Agreed.
Looking at expenses. Forex fluctuations played a role again. The statements show an exchange rate fluctuation loss this quarter, about 18 crore.
Right, whereas last quarter they actually had a small gain from Forex, so that's another negative swing factor, albeit smaller than the GRM impact.
And then there were these accounting policy changes mentioned, two of them.
Yes, two specific changes they highlighted. The first one relates to how they account for property, plant, and equipment, PPE, specifically linked to corporate environment responsibility obligations, CER.
Okay, environmental costs hitting the books differently.
Essentially, yes. The change meant adding about 101 crore to PPE, increasing depreciation expense by about 18 crore, but decreasing other expenses. The net effect, though, was actually an increase in the loss before tax by about 6 crore for the quarter.
So a technical accounting change, but it still made the loss slightly worse?
Correct. It shows how evolving regulations, especially environmental ones, directly flow through to the financials now.
And the second change?
That was making a provision, about 14.5 crore under other expenses. This was for something called Renewable Consumption Obligations, or RCO. It relates to the previous year, but was booked now because of new guidelines that kicked in on April 1st, 2024.
Okay, another compliance-related cost appearing.
Exactly. And connecting this to the bigger picture, these adjustments, the CER and RCO ones, they signal this trend where environmental and, social governance factors aren't just talk anymore. They're becoming real, mandated financial items.
Right, they directly impact the numbers we see.
Absolutely. Yeah. Now, beyond those specific expense items, let's look at the broader financial health picture using some key ratios.
Okay, like debt levels.
Yeah. Total borrowings have crept up.
Yeah.
They stood at over 13,600 crore at the end of June 2025.
And how does that compare?
It's up from about 12,900 crore at the end of March and just over 11,800 crore a year ago. So a steady increase in borrowing.
Which naturally affects the debt-equity ratio.
It does. That ratio has climbed to 1.08 this quarter. It was 0.99 last quarter and 0.889 a year ago.
So over 1 now, meaning more debt than equity.
Correct. It suggests, a greater reliance on debt financing, which isn't unusual, but it's a trend worth watching, especially when profitability is under pressure.
And speaking of pressure, how's their ability to actually cover the interest on that growing debt, the interest service coverage ratio, the ISCR?
Yes. And this is where the numbers get quite concerning this quarter. The ISCR plummeted to 0.85.
0.85, below 1.
Yes, below 1. To give you context, last quarter, Q4 FY25, it was 4.76. A year ago, Q1 FY25, it was 3.03.
Wow, that's a massive drop. From over 4 down to below 1 in just 1 quarter.
It's a huge decline. And an ISCR below 1.0 is a significant warning sign. It basically means the company's operating income wasn't even enough to cover interest expenses for the period.
So they didn't earn enough from operations just to pay the interest bill on their loans.
That's what 0.85 implies, yes.
Yeah.
It's a situation that raises red flags for lenders and indicates potential financial strain.
That seems like the most alarming number we've discussed so far.
It's certainly up there. It speaks directly to immediate financial viability concerns.
Mhm.
And related to that, their operating margin was negative 1.06% and net profit margin negative 1.57%. So losses across the board operationally and net.
When you see the ISCR drop so sharply, like you said, from 4.76 to 0.85, what does that signal most strongly? Is it just the low GRM or is something else potentially dragging it down so fast?
It's primarily driven by the collapse in operating profit, which itself is heavily influenced by the GRM. But the speed of the fall is what's really striking. It suggests the profit buffer, they had just vanished very quickly this quarter, leaving them immediately vulnerable on the debt servicing front.
Okay, shifting gears slightly, what about strategic moves or external factors mentioned in their report? Anything noteworthy there?
Well, the board meeting on July 18th didn't just approve these financials. They also appointed a new cost auditor, Ms. Bandyopadhyay Bhaumik & Co., for the current fiscal year. Standard procedure, really.
Right.
But perhaps more interesting strategically is that the board recommended an amendment to the object clause of their Memorandum of Association, the MOA.
The MOA, that defines what the company is fundamentally set up to do, right?
Exactly. It sets out the scope of their business activities. Amending it requires shareholder approval, usually at the annual general meeting.
So what could changing the object clause signify?
It often signals a strategic shift is being contemplated or enabled. It could be paving the way for diversification, perhaps into, say, renewables, or expanding further into petrochemicals, or maybe even exploring new geographical markets. It basically gives the company official permission to pursue new lines of business.
Interesting. So potentially looking beyond traditional refining.
It could be. It's something to watch whether the shareholders approve it and what follows. It might be a response to the kind of margin pressures we're seeing.
And what about the big global issues? Did they comment on the impact of things like geopolitical tensions?
They did address that. The report mentions they assess the potential impact of U.S. tariffs, the Russia-Ukraine conflict, and the Israel-Iran tensions.
And their conclusion?
Their assessment, according to the report, was that these factors were not significant on the carrying amounts of their major assets like plant equipment, inventories, receivables. They stated they believe the value of these assets will be recovered.
Hmm, not significant. That feels a bit surprising, maybe, given how much global energy markets have been affected by these events.
It does stand out. Many energy players globally have recorded significant impacts, positive or negative, from geopolitical volatility affecting prices, supply chains, demand.
So, is MRPL saying they're uniquely insulated or perhaps just taking a specific view on asset valuation right now?
It's hard to say definitively from just that statement. It could reflect effective risk management or hedging strategies they have in place, or it could be, perhaps, a management perspective focused strictly on the book value of assets rather than broader market impacts. It's certainly a statement that contrasts with the general narrative of volatility affecting the sector.
Yeah, one to keep an eye on in future reports, maybe. Okay, so let's try and pull this all together. A quick recap of our deep dive into MRPL's Q1 FY26.
That's good.
We saw a pretty significant financial loss this quarter, a big swing from the profits they were posting previously.
Driven largely, it seems, by that lower gross refining margin, just $3.88 per barrel. Plus, some accounting adjustments for environmental and renewable obligations also nudged the loss up a bit.
Right. And alongside that loss, we saw debt levels increase.
Yep, total borrowings went up, pushing the debt-equity ratio just over 1.
And maybe most worryingly, that sharp drop in the interest service coverage ratio to below 1, meaning operating income didn't cover interest payments this quarter.
A key indicator of financial stress, definitely.
But it wasn't all negative. On the operational side, they had that record crude processing month in April.
Yeah, highest ever April throughput, and they completed some major unit shutdowns as part of their maintenance and efficiency efforts. So the underlying operations seem to have had some positives.
It really highlights the complexity, doesn't it? Understanding these reports gives you, the listener, a much clearer view of what's really going on inside these big companies and the sector itself.
Absolutely. It's about seeing beyond just the headline profit or loss number.
So here's something to chew on. We see MRPL hitting operational milestones like that record April processing, yet facing serious financial headwinds, like the low GRM and the concerning ISCR, plus rising debt. What does this tell us about that constant battle between internal efficiency, what a company can control, and those powerful external market forces they can't?
And maybe what kind of resilience does a refiner need to navigate this incredibly volatile global energy landscape today?
Definitely food for thought. We'll leave it there for this deep dive.